Hey, so today we're going to cover 7 different financial goals I think everyone should try to achieve by age 30. Even if you're still in your early 20s or even over 30, these milestones can still apply to you because we're really just talking about the big financial goals that everyone should focus on for long-term success when it comes to money. So let's start with number 1. Pay off all high-interest debt, and we generally say over 6%, which is about the return you might expect from investing in the stock market over the long term. So paying down debt at 6% is like getting a risk-free 6% return. Paying down credit card debt at 18% is the same as paying yourself an 18% return. That really puts things into perspective, right? Now, for most of us, the most common form of high-interest debt involves credit card debt, but this can include personal loans or general debt consolidation loans as well. Now, millions of people carry this kind of debt, so don't worry, it happens to all of us. It happened to me. You should absolutely pay this off. Now, pay off this credit card debt first because it can carry interest rates as high as 20%, which can really eat away your wealth really quickly. That's why you should pay down your high interest debt ASAP. If you want to learn more about how to approach paying down debt, I'll link another video on this below in the description. Number 2, establish credit. If you want to buy a home, car, or really any large purchase in the future, you'll want to establish good credit now so that you can borrow money at reasonable interest rates down the road. Now, you should establish credit ahead of time, and the earlier the better, and then use it responsibly. Now, credit is usually expressed as a 3-digit score, so you should focus on this first, and then 50% of that credit score is actually determined just by your payment history and then your credit history. The higher your credit score when it comes time to borrow for large purchases, the more likely you can save on interest. One simple step to establish credit that you could take is by opening a no-fee, cash-back, very simple credit card, and then only spending a small portion of your overall expenses on this credit card. This allows you to get the clock started on that credit history, and then if you're only spending a small amount every week, put yourself in a better position to actually pay that card off in full every single month. That way, you don't have to dip into savings to pay down this card. If you can't open a credit card, you can look into a secured credit card, which is basically a credit card that is backed by a cash deposit that serves as collateral should the cardholder default on payments. Aside from the deposit, secured credit cards function like any other credit card and allow you to establish credit just the same way. If you already have credit, you don't necessarily need to go out and open a bunch of credit cards. That would actually hurt your credit score. Instead, keep it simple and follow these rules. Pay off the balance 100% each statement date or on a specified interval. Only use your credit card for expenses that you could pay off right now. Don't overspend. Lenders will charge you a lot more money if you don't have good credit, especially when it comes to mortgages. Establishing credit early on is a great way to reduce the amount of interest that you might pay for that future home or car or any large purchase. Number 3, establish your cash buffer. In general, you should hold enough cash to do 3 things: cover unexpected emergencies, pay for your monthly expenses, and then meet any short-term goals. A good emergency fund should contain between 3 to 6 months worth of expenses, so you'll be covered in the event of job loss or any large unexpected expense like a car repair or medical problem. To figure out this number, total up what you spend in the average month and then use that as your starting point. Now, having a solid emergency fund can also keep you out of debt if something large comes up. That way, you don't need to put something on a credit card that you can't pay off right away. Set your emergency fund aside in some kind of savings account, and ideally, you should pick an account that earns more interest than what you'd get in your checking account. For my daily expenses, I like having at least a couple months worth of cash in my checking account or my main bank account. This way, if I have a ton of expenses one month, I don't have to worry about having enough cash in my account. I don't really use my checking account for daily use as I use my credit card for everything, but it's always nice to have a good buffer in this account as well. And then you also want to have cash on hand for any short-term goals. Now, we define short-term as anything within 3 to 5 years. I like to say 3 years, some people like to say 5. For example, if you're saving to go on a big vacation next year, you probably don't want to take any market risk with those savings. That way, you'll feel confident when the short-term market fluctuations won't cause you to come up short when it's time to book those flights or hotels. Think about it this way. If the market dropped 10% this year, how would you feel about taking that vacation? Probably not so great, I bet. Taxes are another great example of a short-term financial goal. I'd never consider investing funds that I might owe to the IRS in the next year. I like to set these aside in a separate account so I'm not tempted to spend it. You gotta pay the IRS on time. Number 4, understand taxes. If you can understand the basics of taxes, you might be able to save money every year by finding ways to reduce your taxable income and then therefore the amount of taxes that you pay. There's an easy one here, and that's increasing your 401k contributions to reduce your adjusted gross income. You don't pay taxes on the money that you withhold pre-tax from your 401k. And if you're a 1099 worker or self-employed, you might have a SEP IRA, which basically does the same thing with your contributions. Those contributions held pre-tax reduce the amount of taxes owed at the end of the year. Here are some simple questions to start with to better understand your overall taxes. What are the differences between standard and itemized deductions? What are some simple ways to reduce taxable income while saving? What are all the withholdings on your paycheck and why are they withheld? I bet you've thought about that one before. Start there and just get a better feel to understand your overall taxes. Number 5, hit subscribe. You made it this far, so you're gonna like more of our content. Hit that subscribe button, okay? All right, number 5, pay off student loans. You should really try to get your student loans out of the ways in your 20s so that you're not held back by this in your 30s. Between my wife and I combined, we had about $80K in student loans, and we always felt like we couldn't plan any big life goals until we paid these off. We would start thinking about buying that first home and then default to, well, not until we pay off our student loans, right? We could never get around to it. When we were able to pay these off in our late 20s, it was by far our greatest financial achievement to date. You might want to consider refinancing your student loans if you have a relatively high interest rate as well. Among all existing borrowers, 5.8% is about the average student loan interest rate. Current refinancing rates from private lenders range all the way from 2.25% to over 12%. Be aware though, if you're refinancing a federal student loan, turning it into a private loan, you'll lose the federal flexibility and benefits. Something to be aware of. Number 6, build up an investment portfolio. Sounds kind of general, right? Well, you might spend your 20s setting up your emergency fund, paying down your debt, getting rid of student loans, making some early contributions to your retirement account. But by the time you hit your 30s, you should start building up a sizable taxable investment account. Now, these are investment accounts that are not IRAs or 401ks, so they offer a little bit higher degree of flexibility and then more liquidity than some retirement accounts. You can think about this as your future home down payment, or maybe just a more general way to build your wealth long term. I always suggest that any savings you don't need to spend within the next 3 or so years, besides your cash buffer, should be invested, because if they're sitting in a savings account just accruing some interest, they're likely not even keeping up with inflation, and that just means you're losing buying power. Time is on your side here. Use it to your advantage and get started early so that you can start letting compounding do the work for you. Lastly, formulate a retirement goal. Okay, I get it. When you're in your 20s and your 30s, retirement seems so far away, and as a result, it can be tempting to ignore retirement savings overall. I remember signing up for my 401k plan at my first job and thinking it didn't matter because I was 40 plus years from retirement. But now, here we are, a little over 10 years later in my mid-30s, and I look back and realize I should have saved even more when I had the chance. For many of us, our 20s are when we have the fewest financial obligations and expenses overall. Try to take advantage of this time in your life. The earlier you can start, the more time your retirement savings have to compound. And compounding just might be the biggest key here. Now, you don't necessarily need to max out your 401k and your Roth IRA every single year, but you want to start to formulate an idea of when you want to retire, how you want to live in retirement, and then how you'll make that happen. You don't need to make 6 figures right out of college to actually live out your retirement goal. Just start early, have the end goal in mind, and then set yourself up for success long term. All right, this is Tony from Wealthfront. Thanks for joining.